All right, let's get right into it. There's this idea, this almost universal belief that the US financial system is just the safest place on earth for your money. It's the gold standard, right? The ultimate in investor protection. But what if that's not the whole story anymore? What if that gold standard is starting to lose its shine?
I mean, this whole rock solid reputation we have, it's really built on two big pillars, right? First, a strong legal system, and second, this vigilant watchdog, the SEC, the Securities and Exchange Commission. The idea is that these two things together create this impenetrable shield for anyone investing in the US markets.
And yeah, this quote here from Kenneth Rogoff, it really nails that traditional thinking. Basically, the belief is, hey, even if something goes sideways, the courts have your back. You can sue, you can enforce your contract, and you'll get paid. That's the promise. Okay, but here's where things get really interesting. Here's the twist. What if that main protector, the SEC, isn't actually watching the entire field anymore? What if, year after year, its slice of the pie, the part of the market it actually oversees, is shrinking? Well, that's not just a what-if scenario. The data shows it's exactly what's happening. So now we're going to dig in and look at the reality of who is, and maybe more importantly, who isn't, under that protective umbrella of the SEC anymore. And honestly, the numbers are pretty shocking. Just look at this chart. It tells a wild story. Back in the year 2000, you had a whopping 85% of US investors covered by the SEC, totally protected. Now, fast forward to 2025, and that picture is projected to completely flip on its head. We're talking only about a third of investors will be under that shield. It's literally vanishing before our eyes. So let's just put a number on that, 67%. By 2025, a full two-thirds of US investors are expected to be operating outside of the SEC's reach. Just let that sink in for a second. The vast majority of the market is essentially going off-grid. So that begs the huge question, right? If all this money, we're talking trillions of dollars, isn't in the public stock and bond markets that we all know, then where in the world is it going? And here's your answer. It's flowing into this whole other universe of assets, a world that's a lot more opaque, a lot less regulated. We're seeing a huge move into private funds, think private equity, private credit, plus a ton of money in crypto, and big bets on foreign securities and real assets. And you might be thinking, okay, so who are these investors? Is this just a few risky players? Nope, not at all. We're talking about the heavy hitters, the sophisticated money. We're talking pension funds, your retirement money, huge family offices, university endowments, even entire countries' sovereign wealth funds. These are the big players, and they are deliberately stepping outside the old protected playground. Okay, so we have to ask the multi-trillion-dollar question, why? Why is this massive great opt-out happening? Well, it's not an accident. It's actually being driven by some really powerful forces on both sides of the equation, both the companies that need money and the big investors that have it. It really is a push and a pull. On one side, you've got the companies. For them, being a public company is getting crazy expensive. The compliance costs, the endless disclosure rules, the constant threat of getting sued, they're desperate for another way. Then on the other side, you have these big investors. They're hunting for bigger returns, and they think, hey, we're smart enough to handle the risk ourselves. We don't need the SEC's training wheels. So they're happily jumping into the private markets to get those returns. So if you boil it all down, here's the bottom line. For a huge and growing part of the financial world, SEC regulation isn't seen as a necessity anymore. It's viewed more like an expensive, optional warranty. And a lot of the biggest customers are saying, no thanks, we'll take our chances. And this shift has massive consequences for how we deal with problems. We're moving away from a system of, let's call it prevention, and toward a system of cleanup. And trust me, those two things are worlds apart. Let's really unpack this because it's so important. Think of SEC regulation as being proactive. It's all about forcing companies to disclose information to stop bad things from happening before they start. It's about protecting the whole system. Now, the legal system, that's totally reactive. It only shows up after the fire has started to figure out who owes what to whom. It's a cleanup crew, not a security guard watching the building. And there's a really powerful analogy to describe this new reality. Relying only on the courts after the fact is like using a fire hose pointed at a dumpster fire. I mean, sure, you can point a hose at it. You might even put the fire out eventually, but everything inside that dumpster is already ash. The damage is done. That power of prevention, it's gone. So, when you put it all together, the shrinking oversight, this great opt out by big money, the move from prevention to cleanup, it all leads to one massive question. A really fundamental question about the future of our entire financial system and the point of its most famous regulator. So, we want to leave you with this thought. If the smartest, biggest investors are all saying, we don't want your protection, and companies are going out of their way to avoid providing it, then who exactly is the SEC protecting these days? And maybe even more chilling, what happens when the next big crisis erupts, not in the regulated market, but in that massive, unwatched part of the financial world?